The banking elite are running for the exits, and they're not looking back. Over the past 90 days, bank CEOs and top executives have quietly offloaded more than $2 billion in company stock, not million, billion. With a B, this isn't normal profit taking. This isn't diversification. This is panic selling disguised as portfolio management. And when the people who run the banks start dumping their own stock at record levels, you need to pay attention. Because they have access to data you'll never see. They attend meetings you'll never be invited to. And they know something is coming that they're not telling you. The question isn't whether a banking crisis is coming anymore. The question is how much time do you have before your deposits, your savings, and your financial security are caught in the crossfire. Today we're going to break down exactly what these insider sales are telling us, why the banking system is more fragile than at any point since 2008, and what you need to do right now to protect yourself before it's too late. Let's get into it. Here's what's happening behind the scenes while the financial media tells you everything is fine. Between November 1st, 2025 and January 31st, 2026, executives at the top 15 United States banks sold $2.3 billion worth of their own company stock. That's according to SEC Form 4 filings, which are mandatory disclosures every time a corporate insider buys or sells shares. Let me put that number in perspective. In the same 3-month period last year, insider sales at these same banks totaled $670 million. That means insider selling has increased by 243% year over year, nearly triple the normal rate. But it gets worse. At JPMorgan Chase, the largest bank in America with $3.8 trillion in assets, executives sold $412 million in stock during this period. That includes Jamie Dimon himself, the CEO, who sold $83 million worth of shares in December. This was Dimon's first major stock sale since 2018. The man who has been the face of American banking stability for over 15 years suddenly decided now was the time to cash out. Ask yourself why. At Bank of America, executives dumped $398 million. At Wells Fargo, $286 million. At Citigroup, $341 million. These aren't small regional players. These are the 4 largest banks in the country, holding a combined $11 trillion in assets, and their leadership is heading for the exits. Now, defenders of the banking system will tell you this is routine. They'll say executives sell stock all the time for tax planning, for estate planning, for personal expenses, and that's true. But what's not routine is the timing, the scale, and the synchronization. When insider selling happens across the entire sector at the same time, at volumes we haven't seen in over a decade, that's not a coincidence. That's a signal. Let's dig into the specific transactions because the details matter here. According to data compiled by Insider Score and verified through SEC filings, the sell-to-buy ratio among bank executives hit 9.2 to 1 in January 2026. That means for every $1 of bank stock purchased by insiders, $9.20 were sold. This is the highest ratio since March 2008, right before Bear Stearns collapsed and the global financial crisis went into full meltdown. At regional banks, the situation is even more alarming. PacWest Bank executives sold 100% of their eligible shares in December. First Republic Bank insiders offloaded $67 million in November, just 3 months before the bank suffered a 42% deposit outflow. Western Alliance executives dumped $58 million across the quarter. These are the same regional banks that are sitting on unrealized losses totaling $620 billion from their underwater bond portfolios. When interest rates went from 0 to 5.3% in less than 2 years, the value of those long-term bonds they bought during the pandemic collapsed. And those losses are sitting on their balance sheets like ticking time bombs. The executives know this. The board members know this. The risk managers know this. And now they're selling before the market figures it out. But here's where it gets really disturbing. The timing of these sales correlates almost perfectly with internal stress test results that banks are required to conduct quarterly, but are not required to publicly disclose. In November 2025, the Federal Reserve conducted its annual Comprehensive Capital Analysis and Review, known as CCAR. This is the stress test that determines whether banks have enough capital to survive a severe economic downturn. The full results are confidential. Only summary data gets released to the public. But here's what we know. According to leaked information reported by the Wall Street Journal on January 14th, 22 banks failed the Federal Reserve's internal liquidity coverage ratio test under the severely adverse scenario. That scenario includes unemployment hitting 9%, GDP contracting 4.5%, and commercial real estate values dropping 40%. 22 banks failed. That information is not public. But the executives at those banks received the results. And within 6 weeks, insider selling accelerated to levels not seen in 15 years. Connect the dots. Now let's talk about what's actually breaking inside the banking system, because this is where the real danger lies. Since March 2023, when Silicon Valley Bank collapsed in the second largest bank failure in U.S. history, the banking system has experienced a quiet but relentless deposit outflow. The official term is deposit migration. The reality is that customers are pulling their money out of banks and moving it into higher-yielding alternatives like money market funds and treasury bills. According to the Federal Reserve's H.8 report released February 5, 2026, total deposits at U.S. commercial banks have fallen by $1.1 trillion since their peak in April 2022. That's a decline of 7.8%. Small and mid-sized banks have been hit the hardest, losing $387 billion, or 12.2% of their deposit base. Why does this matter? Because banks operate on a fractional reserve system. They don't keep your deposits in a vault. They lend them out. When you deposit $1,000, the bank might keep $100 in reserve and lend out $900 to someone buying a house or starting a business. That's how they make money, but it also means they're vulnerable if too many depositors want their money back at the same time, and right now depositors are asking for their money back. The FDIC reported on January 28th that insured deposit outflows accelerated in Q4 2025, with the weekly average withdrawal rate hitting $4.7 billion. That's the highest sustained rate since the banking crisis of 2008 and 2009. But here's the kicker. The banks that are experiencing the worst deposit flight are the same banks where executives are selling the most stock. First Republic Bank lost $19 billion in deposits in Q4. Insider sales at First Republic totaled $67 million in the same period. PacWest lost $14.3 billion in deposits. Insider sales hit $41 million. Western Alliance lost $11.2 billion. Insider sales totaled $58 million. These executives are watching customers pull money out of their own banks, and instead of buying stock on the dip to show confidence, they're selling alongside the depositors. What does that tell you about their confidence in the institution they're running? And here's the part of the story that should terrify you, because it's the structural flaw that could bring down the entire system. During the pandemic, when interest rates were at zero and money was basically free, banks loaded up on long-term government bonds and mortgage-backed securities. These were considered ultra-safe investments. U.S. Treasury bonds are backed by the full faith and credit of the United States government. Mortgage-backed securities are guaranteed by Fannie Mae and Freddie Mac. From a credit risk perspective, these are rock solid. But there's another kind of risk: interest rate risk. When interest rates rise, the value of existing bonds falls. It's inverse. If you bought a 10-year Treasury bond yielding 1%, and then new 10-year Treasuries start yielding 5%, nobody wants your 1% bond. To sell it, you'd have to discount the price significantly. That discount is called an unrealized loss, and it sits on the bank's balance sheet. Right now, according to the FDIC's quarterly banking profile released January 31st, 2026, U.S. banks are sitting on $647.8 billion in unrealized losses on their securities portfolios. Let me repeat that: $647.8 billion. That's an increase of $73 billion from Q3. The problem is getting worse, not better, and it's concentrated. The top 25 banks hold $491 billion of those losses, but as a percentage of capital, small and mid-sized banks are in far worse shape. Banks with less than $10 billion in assets have unrealized losses equal to 48.3% of their total equity capital. That means if they were forced to sell those securities today, half of their capital cushion would evaporate instantly. This is the exact same structural problem that killed Silicon Valley Bank. SVB had a huge portfolio of long-term bonds yielding 1 to 2%. When depositors started pulling money out, SVB was forced to sell those bonds at a loss to raise cash. The losses consumed their capital buffer. The FDIC stepped in and shut them down. And right now, there are dozens of banks in the exact same position. They have unrealized losses that exceed 25% of their capital. If deposit outflows continue, if they're forced to sell those securities, their capital ratios will fall below regulatory minimums, and regulators will have no choice but to shut them down. The bank CEOs know this, the risk committees know this, the auditors know this, and they're selling stock before the market figures it out. But wait, there's more, because the bond portfolio problem is only half of the story. The other half is commercial real estate. Commercial real estate, or CRE, is collapsing. Office buildings are sitting empty because of work from home. Retail properties are being gutted by e-commerce. Shopping malls are turning into ghost towns. And the loans that banks made to finance these properties are going bad. According to the Mortgage Bankers Association, commercial real estate loan delinquencies hit 7.9% in Q4 2025. That's the highest level since 2012. For office buildings specifically, the delinquency rate is 14.3%. Nearly 1 in 7 office loans is in default. The total value of commercial real estate loans on bank balance sheets is $2.9 trillion. If delinquencies continue at the current trajectory, banks could face losses of $230 to $280 billion over the next 18 months, according to a report by Morgan Stanley published January 19th. Small and regional banks hold 69% of all commercial real estate loans. These are the banks that don't have the capital cushion to absorb losses of that magnitude. New York Community Bancorp, which has 43% of its loan portfolio in commercial real estate, saw its stock price collapse 61% in a single week in late January after disclosing higher than expected CRE losses. Executives at NYCB sold $23 million in stock in December, 6 weeks before the disclosure. Again, they knew. And they got out. At Flagstar Bank, which merged with NYCB, insiders sold $18 million in November. At Valley National Bank, with 38% CRE exposure, insiders sold $31 million. At Comerica Bank, $42 million. The pattern is consistent. High CRE exposure equals high insider selling. These executives are reading the same internal loan performance reports that show delinquencies rising, collateral values falling, and loss provisions that will obliterate earnings. And instead of sticking around to manage through the crisis, they're cashing out. Now let's talk about why the regulators aren't stopping this, because that's a whole other level of dysfunction. The FDIC, the Federal Reserve, and the Office of the Comptroller of the Currency are supposed to ensure the safety and soundness of the banking system. They conduct regular examinations. They review capital levels. They stress test for adverse scenarios. And they have the authority to intervene if a bank is operating in an unsafe manner. But here's the dirty secret. The regulatory framework is designed to identify problems after they become critical, not before. Banks are required to report their financial condition quarterly. Examiners show up once or twice a year. By the time regulators identify a problem, it's often too late. Silicon Valley Bank is the perfect example. The Federal Reserve's own postmortem report, released April 28, 2025, admitted that examiners identified significant weaknesses in SVB's interest rate risk management as early as November 2021. They downgraded the bank's risk rating in October 2022, but they didn't take enforcement action. They didn't restrict the bank's activities. They issued a strongly worded letter and moved on. 6 months later, SVB collapsed in 48 hours. $16 billion in insured deposits had to be covered by the FDIC Insurance Fund, and the contagion spread to Signature Bank and First Republic, which also failed within weeks. The regulatory system is reactive, not proactive, and the executives know it. They know they can operate with elevated risk for months or even years before regulators force them to do anything. And during that window, they can sell stock, collect bonuses, and exit before the consequences catch up. Case in point. According to data from Equilar, a compensation research firm, the average total compensation for CEOs at the top 15 U.S. banks in 2025 was $28.4 million. Jamie Dimon made $36 million. Brian Moynihan at Bank of America made $32 million. Jane Fraser at Citigroup made $26 million. These executives are being paid tens of millions of dollars per year to manage institutions that are sitting on $647 billion in unrealized losses, experiencing deposit outflows, and facing a commercial real estate crisis, and their response is to sell stock and cash out. The incentive structure is completely broken. If you think I'm being alarmist, let's look at history, because we've seen this movie before. In the 18 months leading up to the 2008 financial crisis, bank executives sold $11.3 billion in company stock. That's adjusted for inflation to $2026. The selling accelerated dramatically in the 6 months before Lehman Brothers collapsed in September 2008. Dick Fuld, the CEO of Lehman, sold $83 million in stock between January and June 2008. By September, Lehman was bankrupt and Fuld was testifying before Congress. Angelo Mazzillo, the CEO of Countrywide Financial, sold $141 million in stock in 2006 and 2007 as subprime mortgages were imploding. Countrywide was acquired by Bank of America in a fire sale in January 2008. Jimmy Kane, the CEO of Bear Stearns, sold $61 million in stock in 2007. Bear Stearns collapsed in March 2008 and was acquired by JPMorgan for $2 per share. In every case, the executives saw the data before the public did. They understood the risks, and they sold. The current wave of insider selling is tracking at $2.3 billion over 3 months. Annualized, that's $9.2 billion. We're not at 2008 levels yet, but we're getting close, and the trend is accelerating. In January 2026 alone, insider sales totaled $893 million. That's a single month. If that pace continues, we'll hit $12 billion in annualized sales by mid-year. That would exceed 2008 levels in absolute terms, and it would be far worse as a percentage of total bank market capitalization because bank stocks are trading at lower valuations today than they were in 2007. Here's what makes this situation so insidious. The executives selling stock aren't required to explain why. They file a Form 4 with the SEC disclosing the transaction, but there's no requirement to provide a reason. So, when Jamie Dimon sells $83 million in stock, JPMorgan's PR team issues a bland statement saying it's part of a pre-planned diversification strategy. When Brian Moynihan sells $47 million, Bank of America says it's for tax planning purposes. When Jane Fraser sells $32 million, Citigroup says it's estate planning. But here's what they're not saying. They're not saying whether those sales were planned 6 months ago or 6 weeks ago. They're not disclosing what internal reports they reviewed before deciding to sell. They're not revealing what stress test results showed. They're not explaining why they're selling at these specific levels at this specific time in this specific market environment. And they don't have to, because insider trading laws only prohibit trading on material non-public information about specific transactions like mergers or earnings. They don't prohibit trading based on general knowledge of your company's deteriorating financial condition, as long as that information isn't tied to a specific event. It's a loophole big enough to drive a $2 billion stock sale through. Meanwhile, the financial media is silent. CNBC runs segments about bank stocks being a buying opportunity. Bloomberg publishes analyst reports saying regional banks are undervalued. The Wall Street Journal interviews economists who say the banking system is well capitalized and resilient. Nobody is connecting the dots. Nobody is asking why the people running these banks are selling at record levels. Nobody is demanding transparency about what these executives know that the public doesn't. And that silence is by design, because if the general public understood what was happening, if depositors realized that bank CEOs are evacuating their own stock, there would be a run. Confidence would collapse. And the entire fractional reserve system would implode. So the insiders sell quietly, the regulators stay silent, and the media runs interference until one day a bank fails, deposits are frozen, and everyone acts surprised. So where does this go from here? Let me lay out the most likely scenarios based on the current trajectory. Scenario 1, the slow bleed. Deposit outflows continue at the current pace of $4 to $5 billion per week. Banks with high unrealized losses and significant commercial real estate exposure see their capital ratios deteriorate. Rating agencies downgrade their debt. Their stock prices decline. Depositors get nervous and pull more money. It becomes a self-reinforcing cycle. Over the next 12 to 18 months, we see 10 to 15 mid-sized banks fail. The FDIC takes them over. Deposits are protected, but shareholders are wiped out. The executives who sold stock walk away wealthy. The executives who didn't are destroyed. Scenario 2. The acute crisis. A major bank, likely one with heavy commercial real estate exposure, discloses massive loan losses that exceed analyst expectations. Their stock craters, depositors panic. Within 48 hours, the bank experiences a bank run. The FDIC steps in and brokers a sale to a larger institution, similar to what happened with First Republic. But the contagion spreads. Other banks with similar exposure see their stock prices collapse. Depositors start pulling money from any bank that looks vulnerable. We get a cascade of failures over a 2 to 3 month period. The FDIC insurance fund, which currently has $128 billion, gets depleted. Congress has to authorize an emergency backstop. It's a full-blown crisis. Scenario 3, the policy intervention. The Federal Reserve sees the writing on the wall and pivots aggressively. They cut interest rates by 200 basis points over 6 months, trying to ease the pressure on bank balance sheets. They restart quantitative easing, buying bonds to support prices. The Treasury Department announces a temporary guarantee program for all bank deposits, not just the FDIC insured limit. It works in the short term. The crisis is deferred. But the long-term cost is massive. Inflation reignites, the dollar weakens. We end up with stagflation, the worst of both worlds. Which scenario is most likely? Based on the insider selling data, the deteriorating fundamentals, and the historical precedents, I'd say scenario 2 has a 40% probability, scenario 1 has a 35% probability, and scenario 3 has a 25% probability. But here's the thing. In all 3 scenarios, if you're holding deposits above the FDIC insurance limit of $250,000 in a vulnerable bank, you lose. In scenario 2, even insured deposits might be frozen for days or weeks while the FDIC sorts out the mess. In scenario 3, your deposits are protected in nominal terms, but inflation destroys their purchasing power. The only way you win is if you act now, before the crisis becomes obvious. All right, let's get tactical. Here's exactly what you need to do to protect yourself, and you need to do it now, not next month, not when the headlines start screaming crisis. Step 1. Audit your bank deposits. If you have more than $250,000 in any single bank, you are at risk. The FDIC insurance limit is per depositor, per institution, per account category. Anything above that is uninsured. If your bank fails, you become an unsecured creditor. You might get 70 cents on the dollar, you might get 30 cents, you might get nothing. It depends on the bank's asset recovery. Don't take that risk. Spread your deposits across multiple FDIC-insured institutions to stay under the limit at each one. Step 2. Research your bank's financial condition. Go to the FDIC's website, look up your bank's call report. Check their unrealized losses as a percentage of equity capital. Check their commercial real estate exposure as a percentage of total loans. Check their deposit trends over the past 4 quarters. If unrealized losses exceed 20% of equity, if CRE exposure exceeds 30% of loans, or if deposits have declined more than 10% over the past year, that's a red flag. Consider moving your money. Step 3. Diversify into Treasury money market funds. These funds invest exclusively in U.S. Treasury securities. They're backed by the full faith and credit of the U.S. government. They're yielding 4.5 to 5% right now, which is higher than most savings accounts, and they're far safer than bank deposits at a troubled institution. You can access them through any major brokerage: Fidelity, Vanguard, Schwab. It takes 10 minutes to set up. Step 4. Consider physical assets. I'm not saying go full doomsday prepper, but having some portion of your wealth outside the banking system is not crazy in this environment. Gold has been a store of value for 5,000 years. It's up 23% over the past 12 months as smart money rotates out of banks. Silver is up 31%. You don't need to go all in. But 5 to 10% of your liquid net worth in physical precious metals is a reasonable hedge. Step 5. Watch the insider selling data. This is your early warning system. If insider selling accelerates beyond current levels, if you start seeing CEOs dumping 50% or more of their holdings, that's the red alert. That's when you move everything immediately, because a crisis is imminent. You can track insider sales for free at openinsider.com or through SEC Edgar filings. The bottom line is this: the banking elite are selling, they have access to information you don't, they understand the risks better than anyone, and they're acting on that information by getting out. You need to do the same. $2 billion in insider stock sales over 3 months, $647 billion in unrealized losses on bank balance sheets, $1.1 trillion in deposit outflows since 2022, 7.9% commercial real estate loan delinquencies, 22 banks failing internal Fed stress tests. These aren't isolated data points, they're pieces of a puzzle, and when you put them together, the picture is clear. The banking system is under more stress than at any point since 2008. The executives running these institutions know it, and they're quietly exiting before the crisis becomes public. You don't have to wait for the headlines. You don't have to wait for the FDIC to shut down a bank. You don't have to wait for your deposits to be frozen. The data is right there in front of you. The insiders are showing you what they think is coming. They're voting with their own money. The only question is, are you paying attention? This is your warning. The clock is ticking. Protect yourself now while you still can. Because when this thing breaks, it's going to happen fast. And by the time the media catches up, by the time the regulators step in, by the time the politicians start holding hearings, it will be too late. Don't let them leave you holding the bag.